Prashant Khemka, founder White Oak Capital with us, Nilesh Shah, MD of Kotak Mahindra AMC also with us, and Sunil Sanghania, founder of Abacus AMC. So we've got a power-packed panel with all the voices in at this point. Let's start with the quick first takes. Nilesh Shah, I'm not going to do the standard rating of the budget, but this one at least had a surprise in terms of capital gains tax. Everyone was in the will she, won't she, will they, won't they kind of a situation. Are you surprised negatively?
No, I'm not negatively surprised. I'm just disappointed. STT was levied in place of capital gains. Now STT and capital both continue since 2018. Now capital gains tax is revised upwards. But there is a non-level playing field between foreigners and locals. If FPI invest in Indian derivatives, they make capital gain. If you and I invest in Indian derivatives or trade in Indian derivatives, it is business income. The foreigners doing trading in our derivatives are earning tax-free income, whereas we pay tax as per applicable slab rates. I think we should create a level playing field between foreign and local participants in the market so that there is equal distribution of taxation.
Got it. Okay. Okay. So, that's the first take. Let me get the first take from Prashant Khemka as well, and then I have a follow-up for Mr. Nilesh Shah. Prashant, what does this mean for equity markets by and large? There is also this angel tax, which is a very interesting thing which has come in. But what's your first take on the budget from a market's perspective, both from a taxation as well as this adherence to the fiscal deficit, are actually beating what they had laid out?
Certainly, thank you, Neeraj. So, first of all, in almost all respects, other than capital gains tax, the budget to me seems like a continuation of prior budgets. The prior budgets were all received well by the investment community, and we have to keep in perspective that the impact of budgets in normal course of events is with some rare exceptions, is fairly short-lived on the markets unless there are some very tectonic shifts in the way the economy is expected to grow going forward. So in some sense, there's a continuity budget. This one negative on capital gains tax, I think, as Nilesh Bhai also mentioned, the revenues could have been generated in other ways as well. It just, besides, first of all, it's a 2.5% increase. Let's forget for a minute the short-term gains tax, which you can't really forget, but the long-term gains tax has been increased by 2.5%. That means if you are going to expect 10 to 11% over time, I think reasonable to expect 10% return from the market, then it has shaved it off by 25 basis points. It's material, because there's no indexation benefit. So your real return has gone down more than 2.5%. It's gone down probably by 5%. It also opens up a Pandora's box in a sense. We had a certain stable tax regime on investors for last several years. 10% on capital long term, 15% short term. Now the increase in this budget also raises the risk in investors' mind, legitimately so, that we can have frequent changes. And when I say changes, usually with things related to taxes, they only go in one direction. So could this imply future tax hikes as well? Already, I think, in my experience of having invested in developed and EM markets, the taxes on investments in equity markets in India are towards the high end, especially the variety of taxes, all taken together. I'm not saying just look in isolation, long-term gains tax or short-term gains tax, and so on, including the dividend tax and the buyback tax and the STT and all those. So at a certain point, there'll be a straw on the camel's back. A theory would be applicable. I don't think this 2.5% increases that straw, but increases the risk that down the line you'll have further uplift in this tax rates. But that is the primary concern with the budget. Otherwise, I think most of the budget, particularly, hopefully, the fine print would have to be looked at. Nilesh Bhai was just mentioning a short while ago on the media, which is what I'm frantically searching for in the fine print, that certain laws have been amended in the direction of ease of doing business, which would allow fund managers like myself sitting outside India to come back to India and live a normal life in India. I'm yet to see that print. My team is looking for it as well. But if such things are indeed included in the fine print, then ease of doing business is what I usually always look for from a budget rather than this text tinkering. The budget is an opportunity. Every budget to me is an opportunity to improve ease of doing business, because all said and done, we are last published, ranked 63rd on ease of doing business. We want to be number one to become a developed nation by 40. We can't become a developed nation by being 63rd nation on ease of doing business.
That's true.
Yeah?
That's
So that
true.
fine print, I'm very much eager to look into as it becomes available.
Yeah. Prashant, I can almost feel the pain. But I think that's the kind of voice that Nilesh Bhai gave as well, and you rightly referred to it. So Nilesh Bhai, I think Prashant makes this important point, that does this open up in a sense, a bit of a runway that people will not have clarity now about whether this is the last of the tax changes and the max tax that we have, which is 20% on short term, or could it be more?
So at least this year, Neeraj Bhai, the details are out. And I'm sincerely hoping that the safe harbor clause which Prashant Bhai referred to, and which I had the pleasure of handing over to the Honorable Finance Minister in my pre-budget consultation, really works out. And next time, both me and Prashant Bhai are in your studio in person, and not I am in local office and Prashant Bhai in global office. And that's the important point. If India has to develop as a regional financial center, we have to bring Prashant Bhai in India, not keep him outside, by changing our rules and facilitating it. And this budget is a step in the right direction. There are changes being proposed to improve ease of doing business, ease of doing investments, and we should keep on taking feedback so that we ultimately achieve our objective of bringing talent into India.
Nilesh Bhai, so a couple of things. I want to ask you about employment, etc. But I just want to play devil's advocate on the capital gains tax changes. Of course, the impact for real estate and gold still has to be understood because indexation goes out of it. But on equities, if the counter argument would have been that look at the kind of gains made in equities by everyone, why should the government not take a little bit more from you? Every other kind of income is also being taxed. What would you say to that?
So one, why do we give tax incentive? We give, like vitamins, tax incentives for correct certain deficiency. Where is the challenge today? Is government doing its job of building infrastructure? Answer is yes. Is private investment coming through as much as they wanted? Even yesterday's economic survey mentioned that now the ball is in private sector's court to take it forward. How will private sector invest if there is no capital formation? The corporate India makes 16 lakh crore of profit, and they give probably 40% of that by way of dividend. Now, is there an investment happening? Answer is it's happening on a limited manner, which is why tax incentives are needed so that capital market can provide capital to our entrepreneurs and they can go and then invest. Today, 9 lakh crore rupees in last 3 years between FY21 to 23 has gone into currency notes. Does people make money on currency note? Answer is no. We need to give them incentives so that currency note, instead of lying in Tijori, comes back into the economy. We have imported on an average 700 tons of gold. In 22 years of this century, our net import of gold, including gold smuggling and people wearing jewelry and passing through green channel, is about $500 billion, more than our foreign direct investment, more than our foreign portfolio investment. Where is that gold lying? It's lying in Tijori. Shouldn't we give tax incentives so that that gold comes out of Tijori and stays in formal economy? Tax incentives are needed to correct the deficiency on low capital formation.
Okay, just that's a good point there. So perhaps we could have been a little softer with long-term capital gains tax there. That's the resounding voice coming through. I just want to get Prashant Khemka, your view on the employment push. And that really, I would say, if I had to predict what tomorrow's headlines will be in all the newspapers, among other things, after capital gains tax, would be the big push for employment. I want to understand from your point of view, do you think that there are some out-of-the-box ideas which could really change things?
Certainly, but before I go to that, I do want to, thank Nilesh Bhai for really batting for the industry on this, regardless of what is there in the fine print, batting for the industry for this change, which would really spawn and it's tied to the employment creation as well. It would spawn a birth of a global hub in India, just like for IT services. India is a global hub with a small change in the policy, the right change in the policy that Nilesh Bhai was referring to, the safe harbor clause, it would lead to India becoming the global hub, just like it is in IT services, becoming a global hub for asset management as well. And think of the employment creation that would lead to. So the employment creation initiatives are very positive in the budget, but what structural measures that can, besides the incentives, other structural measures which come along with ease of doing business, not just related to the safe harbor clause, but across board. The finance ministers talked about reviewing the tax code within the next 6 months by the time of the next budget. Simplification of tax code, ease of doing leads to greater ease of doing business. That itself should spawn and have a far deeper and much larger impact on job creation. Then, what is also welcome, very welcome, in the interim, the higher allocation to job creation initiatives, be it in skill development, upgradation of skills, and incentives to manufacturing sector for first-time employees, and the incentives in form of contribution to the pension plans. All those are very welcome moves, but you have to think in terms of combination of these fiscal incentives, which may work very well in the short to interim time periods. Combine that with the structural job creation possibilities that would come with greater and greater ease of doing business.
Absolutely. So overall, a good budget. No one likes to pay more taxes. So you're seeing that also play out, not just in the markets, but from some of the conversations we're having. Having said that, markets have recovered from its worst levels of the day.